Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Short Verticals. I'm filling in today, but today we're going to be talking about using charts to plan the timing of credit spreads. Should be an interesting discussion. We need to figure out whether we're going to do a bullish or a bearish credit spread, and then when are we going to do it? Interesting topic. I think there's a lot to cover. Before we can get to that, though, let me first of all say hello to everybody that's already chatting in. Great to see all of you out there. Good to see you, Will and Kevin, CC Martyr, Josh, John, Richard, David, Life in the Fast Lane, Stoic. Who else is out there? Chris, everybody, thanks for joining us week after week in our webcast. We always appreciate your attendance and your contributions in these discussions. If you're here in this one for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, well, those recordings are a great way to watch the webcast. But if you'd like to be here in the live stream, this is a Thursday webcast series. This one kicks off promptly at 2 Eastern each week. So I'd love to have you here in the live stream audience. Now, I also need to let my live stream audience members know that my very good friend Kevin Horner is out there hanging out in the chats. Kevin's going to be keeping an eye on the questions that come in through the chat function on YouTube. And if I can't get to those, Kevin's there to pick up my slack. Thanks for having my back there, Kevin. Kevin and I would also like to issue an invitation to everybody watching to follow us on social media. You can find Kevin and me on X. Follow Kevin there at Kevin Horner CS. You can follow me on X at Cameron May CS. Now you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS will take you to my profile and you can follow me there. But let's get into this discussion. And as we do, of course, credit spreads, short vertical spreads carry risk. So we need to bear that risk in mind. Bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Schwab does not recommend the use of technical analysis as a sole means of investment research. Pardon me. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for today's discussion. Today, I really do want to focus on, of course, we're talking about short verticals. We're talking about credit spreads. Some traders, though, consider the timing of when to enter, when to exit those spreads as absolutely vital. I think that just makes sense. So how might a trader use charts to supplement that effort? Well, we're going to take a look at the broad market trends first to maybe help the trader gauge whether they choose to enter a bullish or a bearish trade first. And then we're going to dig into an individual stock chart and look at how the trader might refine the timing of their entries or their exits. Again, a refinement is not a guarantee of success, but let's go to the charts. Let's go have a look at what's going on with the S&P 500. Now, I'm going to be using this index as I put myself in the shoes of the would-be short vertical spread trader. The first question they might be asking themselves is, well, if I'm going to place a credit spread, if I'm going to do a short vertical spread, is it going to be a bullish spread or is it going to be a bearish spread? Doing bullish trades when the markets are persistently bearish can be tough. Doing bearish trades when the markets are persistently bullish can also be tough. The markets may provide a tailwind helping a trader erase some of those timing issues. It can really help overcome some of those sorts of pressures. On the other hand, doing trades against market trends really requires a much more higher level of precision with the timing. It's tough. So let's see what's going on with the S&P 500 and the S&P. Yeah, I don't have any revelations for anybody right now. We're trading just below 7,000 on the S&P. We've been making higher highs and higher lows pretty much uninterrupted since April. But let's put ourselves in the shoes of our would-be credit spread trader. And how about we plan a trade out here for that next monthly expiration? We're looking at that February 20th expiration, those contracts. So why not January? Well, January is almost over for the traditional third Friday expirations. Why not weeklies? Could we be planning some time frame before February 20th? Yes, we certainly could. There's nothing inherently wrong with trading weekly contracts, but just a general statement might be made about those. That is, they tend to be a little less liquid. They tend to have a little bit wider spreads between the bid price and the ask price, a little harder to get into, a little bit harder to get out of. And so let's say that our trader, for those reasons, is looking out here to the third Friday of February, the 20th. And the first decision they're attempting to make is, well, do we think the S&P, and therefore maybe most stocks with it, is likely to be higher or lower from here? Before I do a little bit of analysis on this chart, chat in, let me know. If you were this investor and you're looking out there till February, would you be leaning toward bullishness or bearishness? And there's not a right or wrong answer. Nobody has a perfect insight into the markets from here. Because there's maybe what might be more obvious to most people, and that is, well, if the markets have been going up and up and up, if that momentum holds, shouldn't we just always be bullish? Not necessarily. There are certainly those contrarians that might be looking at really what the S&P has done over the last 2.5 months, and that is not much of anything. It's gone down, it's gone up, but really from before Halloween to right now, the S&P is up 0.5%. Good Koopa says sideways. All right, now it's slightly upward, but it is a slowing of this previous trend. We had a great run up until Halloween. But could this be the beginning of the end for the bulls? Maybe, but a traditional technician might just assume, unless evidence is strongly supports the contrary, that trend is likely to persist higher. It could turn on a dime. This may be the top. We don't know that. But let's say that our trader is looking at this and they're saying, well, unless there's just not necessarily overwhelming evidence to the contrary, but at least some strong evidence to the contrary, what we see as a trader is looking at the S&P, maybe they look to see what are the most recent lows doing. Recent lows seem to be progressing higher. What are the most recent highs doing? Those recent highs seem to still be progressing higher. There still seems to be an intact upward trend. And even if we look at things more recently, if I zoom in on just the last 48 hours of trading, what might we call this? Right there. As we attempted to sell off on the S&P. Maybe some of you remember this. Yesterday, things weren't looking terribly good, but by the end of trading, we had largely recovered, creating what's known as a hammer candle. This, for a technician, is sometimes interpreted as really just a continuation of a bullish trend bouncing off of a price low. So let's say that for those reasons, or maybe any number of others, maybe our trader has a favorite technical indicator that I'm not displaying right now. Maybe they see things in a different way, but let's just say that our trader has concluded that, no, I don't want to draw another oval. Let's remove this drawing and tack on a trend line. Let's just say that our trader thinks that more likely than not, come February 20th, looking in the rearview mirror, we'll see that we've reached new highs. They expect things to be bullish. All right, well, that's an important decision to make. Is that the right one? I'm not making that argument. But I am making the argument that for a trader, this could be a very important decision. And hopefully we're right more often than not. So, let's see. Kevin says, is there a morning star here? There may be the beginning elements of a morning star. Oh, actually, no. I'm sorry, Kevin. Yeah. So what Kevin is noting here, I don't know, there could be some splitting of hairs. I don't mind talking about this detail on charts a little bit more because charting is the point of emphasis today. And by the way, if you want to expand your knowledge of charting, you may want to check out my webcast series that I teach on Fridays of every week. It's called Advanced Charting Techniques. But Kevin asked about something known as a morning star, which is it's something. It doesn't have to be a hammer like this, but it's a candle that sort of exists by itself below the previous candle and below the following candle. So typically it's identified by a gap down and then a gap up. And it's seen as a bullish reversal candle in the short term, might just mean that we're moving to the next level of resistance, wherever that turns out to be. So yeah, I think there could be that case where I would say there are some nitpicky traders out there that might take a little exception to this being identified as a morning star candle. And that is because there is some overlap between, since this is Thursday, this low candle was Wednesday's candle, and this is Tuesday's candle. There's a little bit of overlap. Do you see this low here actually intersects below the high of Wednesday's candle? There are some purists for a morning star that would require that there is a gap separation between those two. All right, Kevin, not a distraction. What this is just emphasizing is there are lots of different ways that a trader might decide that the market seemed prepared to advance, at least through looking at charts. But let's zoom back out and just say that our trader has made their decision. Today's example trade is going to be bullish. So next up, I want to have a look at an example chart and look at some ways that a trader might gauge the more precise timing of their entry and possibly their exit for their trade. So let's do that. And as I do, today's trade we're going to be doing on NVIDIA. Obviously, question might arise, why NVIDIA? Well, for some traders, there could be some pre-qualifiers before we ever look at the chart. Among those are the price per share. High-priced stocks tend to have higher-priced options, for better or for worse. Also, liquidity is a typical point of emphasis for options traders. Illiquid stocks and illiquid options, or illiquid stocks, tend to have illiquid options, and illiquidity means it's hard to get into them, hard to get out of them, harder to trade. So NVIDIA happens to be one of the biggest companies in the world. It's priced a little under $200, which in the grand scheme of today's markets is kind of on the lower end of stock prices, especially for big companies. So let's say that our trader, for that reason or for any number of others, they're looking at the chart and they're thinking, hey, with that backdrop of the S&P 500, what if I do a credit spread, a short vertical on NVIDIA? We're going to be doing a bull put spread on NVIDIA. But what might lead the trader to conclude that maybe right now, today, is the time to be doing one of these on this stock? First thing the trader might do, again, is look to see what's been the general trend of our stock. Well, if we just look at this manually, you might see that the stock has had down cycles, lower highs and lower lows. It's had up cycles, higher highs and higher lows. It's even gone sideways at times. But most recently, what are the lows doing? Here's a low, and it looks like we may have just established a new low. Here's a cyclical high, and here we've established a recent high. So high, higher low through at least one lens. For those who look at the cycles that a stock goes through, we might be looking at an upward trend. Now, another way that that might be defined is instead of doing this manually, the trader might employ like a technical indicator, a trend indicator, and possibly the most common trend indicator out there. In my experience, it's the most common indicator of any type is a simple moving average. And I'm going to add one to our chart here. So let's go up to our little flask icon. Let's type in simple moving average. Add that to our chart. And we're going to be doing a trade over the course of about 5 weeks. By default, the simple moving average that comes up on Thinkorswim is only for 9 days. That may not be a long enough context to assist with the timing of sort of an intermediate term trade. This is right on the sort of cusp between short term and intermediate, according to the definitions of a number of technicians. So this very short term time frame, 9 days, might not be enough. Let's expand that out. And I'm going to take that out to actually the opposite side. Instead of being at the cusp of short term to intermediate, let's go to the cusp of short term to long term. Let's use a length on our moving average of 100 days. That's about 5 months worth of data, 4.5 to 5 months worth of data. And I'm going to click OK and click Apply. Why did I choose that time frame? Well, maybe our trader here is just trying to get on what they consider to be the correct side of bullishness or bearishness over an intermediate term at least. And so this moving average, if you're not familiar with this, I've selected a 100-day simple moving average. It's a trend line that's drawn by calculating over a 100-day period the average closing price for our stock and plotting it on the chart. So right now you'll see 183.67 is the current average price over the last 100 days. And that average price changes as the stock fluctuates up and down. So back here in June, when average prices were lower, we can see that our line for representing those averages was also lower. So that line changes, it moves over time. It is a simple moving average. All right. So a couple of different ways that moving average might be used in the planning of our credit spread. Number one, it may assist with identifying the general direction, because that direction can get a little bit muddy at times. We're chopping up and down recently. If we're not doing, let's clear up our drawing set here. If we're not just subscribing to higher highs and higher lows, for some traders, they might struggle to identify a trend. And for this moving average, as long as it's sloping upward, the interpretation might be that that trend is still bullish, still intact, and it may tilt the scales toward that credit spread, that bullish credit spread that we were planning. Now, a second way this moving average might be used, number one, is to get that longer term sort of context for planning our trade. Number two has to do with the precision of timing, because within a trend, there can be still really bad times to enter into a bullish trade. Imagine bullish traders who got into trades right back here. Those things might really be struggling even right up to the present day, despite the overall bullishness of NVIDIA over the last 9 months or so. Now, there could be other times, these sort of cyclical lows, where it might be, at least historically, more advantageous for the timing to be getting into those new bullish trades. They're in keeping with the trend, but also the timing might be better. So our simple moving average might assist with that timing. One way that the trader might look at this is if the prices move back toward the simple moving average while staying above it, and we start to see what appears to be cyclical lows, that might assist with the timing. But also, if we come down and actually touch that moving average, quite commonly these averages can act as price floors, because for stock traders who have been waiting for price to come down from highs, as long as maybe we can get it at average prices, maybe that can spur some activity there. That's the concept there. So quite commonly, our trend line can also act as like a price floor. Now, in this case, it happens to be that it looks like it's been acting as a pretty solid floor for the last week or so. It's not a guarantee that we are going higher. As of this moment, it does seem that we are at the moment. But that is a second way that charts might be used in the planning of these credit spreads, getting down to the timing here with using the moving average for trend, but also a price floor. Now, I want to explore one final timing element, and that is, just because we've gotten down to a floor doesn't mean that floor can't break. At the moment we're reaching down to that floor, what's the momentum of price? Let me zoom in on this. In order to get from here all the way down to here, price had to fall. In other words, the sellers have momentum. And what some traders might do in looking for, again, the refinement of the timing of their entry, they might want to see that momentum shift from selling back to buying in a definable way. Now, there are a number of different ways that we might define it, but one way that you hear discussed somewhat frequently is looking for what we call a K-hold or a Cahold entry. It's an acronym, C-A-H-O-L-D. It stands for a close above the high of the low day. It's a bit of a mouthful. Really, actually, I use a different acronym for my trading purposes. It's easier to me. I say CALC, C-A-L-C, close above the low candle. Same implications. Basically, what we're looking for here is we're looking for the day-to-day highs and lows to reverse and start moving in the direction of the trend itself. So here's our peak. What did the next day's high do? It got lower. What the subsequent day's high do? It got lower still. So we're seeing lower highs. Now, at the same time, we're seeing generally lower lows. But really, what the trader is looking for is finally, as the stock is pulling back, which candle sticks its tail down the furthest. Calc sounds like calculus. I know it does, Chris. The funny thing is, calculus sounds like we're complicating things, but calc for me uncomplicates the CAHOLD, close above the high of the low day. Maybe I'll explain that, the difference here. Anyway, but when a trader is looking for a shift in momentum, they're looking at those day-to-day lows, and the candle that sticks its little tail down the furthest, we then define that as, here's the fancy term for it, the low day. So there's our low day. And then as the signal that the momentum has shifted, and we've gone from selling momentum to buying momentum, the trader looks for a closing price above the highest point of that low day. So let's draw on a line here. So here's our low day. Here's the highest point of that low day, right there. And we're just looking for some subsequent day. It doesn't have to be the next day. It could be the following. It could be 2 days following. But a closing price above the highest point of that low day, and even though the markets still have about 90 minutes left to trade, it's looking like we're pointed in that direction for NVIDIA. Right now, clearly above the highest point of that low day. Now, there were some near misses here. Here was a low day. Notice that a low day doesn't have to be a red candle. Here was the highest point of that low day. On Tuesday, did we close above the highest point of that low day? Nope, we didn't. We were waiting for an entry, and then we got a new low day. So this is, according to those who use this K-hold entry, seems to be the more current low day. Now, let me explain my calc abbreviation, CALC. It's simply a close, like this, above, like here, the low candle. Above just means above everything. What does above mean? It means above the whole thing. Yeah, close above the low candle. It's the same thing. So don't get too caught up in the acronyms. Am I using the right one? Calc versus K-hold doesn't matter. Mine, and you won't find calc anywhere else. That's just one that I think of. So here's what we've accomplished with the charts in the timing of the entry of this would-be credit spread. First, we made that decision using the S&P 500 whether we're going to go bullish or bearish. Then we moved to the individual stock chart, define that the intermediate to longer term trend, trying to stay consistent with that again. Then for timing, are we at or near cyclical lows, and has the momentum shifted in the direction of where we intend to trade? So adding all that up, if we're looking at it through that lens, then today's the day on NVIDIA. Now, I'm not saying everybody should be trading NVIDIA credit spreads. I'm not. This is just an example. Vic says, so calc is more like no wick at closing. Well, Vic, it doesn't have anything to do with the wick. It's just, did we close above the low candle? And if you say, well, is that the body or is that the wick? Well, the wick is part of the low candle. So yes, it includes the wick. Anyway, good question. Let's do our trade. So for today's example trade, let me zoom back out again. I'm still zoomed in here. Looks like a recent low is just above that 180. Let's say that our trader thinks that price is supposed to rise or at least stay above our trend line here as we approach that February 20th expiration. How about if we take a look at maybe structuring a vertical spread that will benefit as long as we're above 180 at expiration? So let's go to the trade tab. Let's go out to the 20th of February. And let's look at, let's change our spread from vertical right now. On your layout, it's very likely just set to single. That just means that we're seeing all the single or the individual strikes. And I'm going to go to the 180 put. This is a bullish strategy. A couple of basic ways that an option trader can be bullish. They can buy calls, that's bullish. Or since we're talking about short in this webcast series, short verticals, we can also sell puts. So selling a put at 180 is going to be the first half of our trade. So here's our example trade. Let's spell example correctly. It's going to be a short put vertical, also known as a bull put vertical. And it starts with the short leg. We're going to sell the 20th of February 180 put. And that looks like that's trading between 460 and 470. Let's call it 465. Now, we actually, if the trader wanted to, that would be a bullish strategy right there. We just sell the put and go ahead with that. Now, it wouldn't be consistent with this webcast series because this is called short verticals. But what is the motivation for turning a short put into a short put vertical? Well, if we sell a short put, we're taking upon ourselves the obligation to maybe have to sell shares at a specified price. So through the 20th of February, for the next 36 days, an RB Tech trader says, if you're bullish, why not just buy the call? And we could, except this webcast series is not called buying long calls. It's called short verticals. Yep. So in this one, we'll talk about it from that perspective, but there are pros and cons. We could go buy a call that comes with leverage. Great. It also has big time exposure to time decay. And also leverage can work in the wrong direction. So there are pros and cons. But let's look at this through the short put vertical lens. Well, if we sell just the put, again, that's a legitimate bullish strategy that has obviously potential drawbacks. The drawback, the primary biggest drawback here being, we're getting into a contract where we might have to sell shares of stock that we don't actually own. Pardon me. This can happen even to somebody who's been doing this for a long time. You can jump into an explanation without just making a quick mental double check that you're saying what you intend to say. When you sell a put, what does somebody have the right to do? They have the right to sell shares to you. So we're taking upon ourselves the obligation to maybe have to buy stock at a specified price, but we don't know how much we can sell it for. That could be a problem. Because if the stock is collapsing in price and we're forced to buy it at 180, ooh, that could really hurt. So what we're going to do to turn this into our short put vertical is at the same time we sell that 180 put, we're going to buy a second put. Let's stick with the same expiration. So we're covered in this position for the full duration of the contract period. And which contract we're going to buy? Well, we're going to buy a less expensive one. Let's say, should we just go one strike increment? Let's go for the $5 widespread. Let's maybe buy the 175 put. And right now that looks like it's trading between 325 and 330, or 335. It looks like it might cost us 330 to do this. So what does this put do for us? Well, now we know we might have to buy the shares for 180. And in an emergency, if we have to, we now know that we can sell those shares, worst case scenario, for 175. Yeah, if we need to. So that limits the downside exposure on this trade to $5. James says, you've been assigned a couple of times, not upsetting. First time's a little scary. Yeah. We really want to understand what we're getting ourselves into here because assignment can certainly happen. And we need to have a plan for what we might do in that event. Abby says, if you go long on the same strikes, turn on the risk is the same, so advantages of choosing a short vertical. Oh, you mean like a debit spread? Yeah, your reward on risk is the same. Exactly right. Yeah, let me show you something. I'm going to make a high-level statement about that. Should we do a credit spread or a debit spread? Well, clearly, in a webcast series about credit spread trading, we're going to do a credit spread today. But is there a massive advantage to doing credit spreads versus debit spreads using the same strikes on the same stock at the same time? Short answer to that is no, there is not. So I don't mean to say that there's an advantage to do debit spreads either. If you really break it down, they're almost identical trades. Let me show you something where I explore that. I explain that using the math of each trade, we do a side-by-side comparison of a credit spread and a debit spread, because that's a big question. Am I choosing the right one? Maybe I should be doing a debit spread instead of a credit spread. Well, just go to our Trader Talks channel, type in debit credit, both at the same time, debit, credit. I can't remember which order I titled this, whether it's credit, debit, or debit, credit. There we go. But look right there. Options vertical showdown. Trade a credit or a debit spread. So Jerry says, why not consider closer to today's date? I mentioned that earlier, Jerry. I talked about maybe doing weeklies, maybe doing January. We just chose 20th of February. If you need to revisit that, you can go check out the archive for this webcast when it gets posted. But this may help you understand, Abhi, exactly why I just said what I said. Because credit spreads and debit spreads, almost identical strategies. There are some little subtle differences that we need to be aware of. But there we go. So this is going to be our trade. We're doing it today on the evidence of what we saw in our charts. It's not a guarantee that it's going to work out, of course. But we need to understand how much can we make on this trade? How much can we lose on this trade? What are the circumstances under which we might make or lose money? So how much can we make? Well, if we're collecting $465 but spending $330 of it, what's the net credit here? Or in other words, the theoretical maximum gain of this trade? That's going to leave us with $1.35, isn't it? 465 collected minus 330 spent. Yep. How much can we lose? What's the theoretical maximum loss on this trade? Well, if we get stuck with the shares at 180, if the contract gets assigned, and then we say, well, all right, well, then I'll sell those shares to somebody else for 175, that would be a $5 loss on the shares. But we did get $1.35 to get ourselves into that mess. So how much would that leave us with as a loss? $3.65. RB Tech Trader says, with a credit spread, at least the stock doesn't have to go up to make money. It can just say the same. That's you know what? With the same strikes on a debit spread, though, that's also true. So that's not an advantage, credit spread versus debit spread. That has to do with whether the strikes were in the money or out of the money for the credit or debit. Yep. And I'm talking about like on the day we did the trade. So yeah, as an example, we're doing an out of the money credit spread, which is where the credit trader would prefer the thing to be at expiration. So on day one, we're already where we need the stock to be. We just want it to stay there or just get better. With a debit spread, we want to be in the money. Same strikes are in the money. That would have identical probabilities for success. Yep. Which was the way Abhi asked that question. It was a great way to ask the question. So Carmen says, where did the $5 come from? So it comes from the 2 contracts we've gotten ourselves into. And we are not into these contracts yet, but let's suppose that we've done this vertical. Well, we sold the 180 put, meaning someone has the right to sell shares to us for 180. We bought the 175 put, meaning we have the right to sell those shares to someone else for 175. So if we buy the shares at 180 and sell at 175, that's a $5 loss. That's where that came from. And of course, you can revisit the recording of this webcast after it's posted if you need to revisit how I came up with this math, because sometimes I'll just state things and it would be nice to have it restated. That's the great thing about a recording. You have all the restatements you need. So look at this, guys. Wait a minute, there's about $3 of risk for every $1 reward. Yep, that's the way higher probability trades work with vertical spreads. That is the trade-off. That's just something that the trader should expect. If we're going for high probability scenarios, and this trade has a high probability of success because we need to be above 180 for this trade to work, to be in position for its maximum theoretical gain, stock's already above 180. Let's see. Just reading the chats. O'Holly says, assuming NVIDIA stays above 180, should the trader, do they have to close this trade at expiration? The answer to that is no. It could, if we're out of the money at expiration, these contracts can just expire worthless. Now, it doesn't mean that this contract can't be assigned. Let's talk about what can happen at expiration. So here's the contract, here's the option that we're intending to sell, and we're looking to maybe buy the 175. I'll draw in a second line to represent that. Okay, so that's about right there. So these two lines represent these two contracts, 180 and 175. Let me just clean things up a little bit. I don't need that one line. Let me remove this little drawing. So here's where we are right now. And here is where the trader would prefer to be at expiration, somewhere in this landing zone. Because if the stock is still above 180, what happens at expiration in most circumstances, in almost all circumstances? Whether we're down here at 185 or we're up here at 195 or higher, anywhere in this green, we're above 180, someone has the right to sell shares to us for 180, but those shares are worth more elsewhere. Just because they have the contractual right to sell to us, does it mean they're going to? No. If the stock's above 180, most likely, with very rare exceptions, this contract just expires worthless, and that 465 becomes a realized gain in our portfolio. Awesome. But at the same time, we hit expiration. What happens to this 175 put that we bought? We have the right to sell shares for 175 that are worth way more than that. Guess what? That contract just expires worthless as well. So we have a realized gain of 465, a realized loss of 330, and guess what? That is our maximum gain of 135. That's if we're up here at expiration. What if we're not? This is where I don't want to draw a line. What if we're down here, below 170? I'm going to make that red so you can understand this is where we do not want to go. This is our no-fly zone. What happens if we drop down below 170? If we're down here at, let's say, 170, or pardon me, 175, that's our lower strike. Let's say we're down at 170 or 165 or whatever. We're just down here. Well, someone has the right to sell shares to us for 180 that aren't worth nearly that much. So they're going to say, hey, Cameron, here you go. You got to pay 180 bucks for my shares. And they enforce the terms of the contract. And they sign those shares. They sell us the shares for 180. And then we're left thinking, oh, crud. Shares aren't worth 180. They're only worth 165 or whatever. Oh, yeah, that's right. I have a contract that allows me to sell those shares for 175. And we exercise that contract. By the way, do we have to call up anybody and actually exercise this? No. If it's below 175, the contract is exercised automatically on the trader's behalf. So what happens is we buy the shares for 180, we sell them for 175 on expiration. That's a $5 loss. Our $1.35 that we collected as a premium up front, as a credit up front, is small consolation, and we're left with a $365 net loss. Now, obviously, we'd have to tack on some commissions there, so it could be a little bit more than that. So this is why it's known as a bull put vertical spread, because it's a vertical because there's a vertical distinction between $175 and $180 vertical price. It's a spread because there's a spread between 175 and 180. It's bullish because we have a preference for a price to be higher rather than lower, and we use puts to construct this. So it's a bull put vertical spread. Someone just asked, can we please check out another chart if we get a chance? We won't have an opportunity today. My apologies. We're going to sort of keep targeted on this one, but let's place our trade. Oh, by the way, one other thing that could happen, you're probably asking, well, what if we don't go below both? What if we're not above both strikes? What if we're right in the middle? What if we're between 180 and 175 at expiration? Let's say we're at 177. Well, this trader has the right to sell to us for more than the shares are worth, and they're going to do it with very rare exceptions. So they sell the shares to us. We have the right to sell those shares for less than they're worth. 175 is less than 177. No, we don't do that. So we wind up owning the shares. Bought the shares at 180, they're worth 177. That's a $3 unrealized loss on our stock. So the credit that we received previously is a little bit of help with that, but we'd be a little bit underwater overall. Okay, so Chris says maybe we just want to close out before expiration. Yeah, a trader might consider doing that, especially in the case that we're going down. If we're going up and up and up and up, maybe they feel a little bit more comfortable pushing it closer to expiration or maybe all the way. So let's place our trade. How do we place this trade? We go to the trade tab. These are the two strikes that we've been selecting, or we've been talking, actually these two. So what we can do is come up here where it says spread single. I'm going to change that to vertical, and it pairs those strikes up with each other. And then we just click on the bid price under the puts column to create our vertical spread. So there it is. Here we'd want to choose the number of contracts that the trader wants. So if there's $365 of risk per contract for vertical spread, if the trader wants to keep it around $1,000, maybe that's 3 verticals. If they want to keep it closer to $365, maybe that's 1. How about for this one? We just do the 1. There we go. Let's see here. It looks like our credit is still, our naturals are around 130, the mids are around 137. Let's say that the trader is looking to get at least $1.35 out of this credit spread. So let's set our limit there, but there's no guarantee that we'll get that thing filled. And let's click confirm and send. So here we are attempting to sell that one vertical, trying to get at least $1.35 for it. If we get that done, someone has the right to sell shares to us for 180. We have the right to sell to someone else for 175. We hope neither one of those happens. We just want to collect that credit and let it all expire worthless. But this is just a little reminder. There's our maximum profit. There's our max loss, a reminder of the commissions, and we could send that order off. Now, I'm just sort of the interloper in this webcast series today. I'm just filling in, so I'm not going to put this into my paper money account. I won't be here to follow up on it next week or anything like that. But that's the process for placing that order. So I'm just going to close it out with that. We've accomplished what I set out to do today. So time for me to let you go. As I do, I want to give you a quick reminder of the resources that you have available to you from Schwab Education. Starting with, if you haven't subscribed to our Trader Talks channel yet on YouTube, please do that. Trader Talks Schwab Coaching Webcast. You can hit the subscribe button right down below the video right now, and it only takes a second, doesn't cost anything. But this is where you can join our live streams. You can find our playlists for previous webcasts. You can also do keyword searches like we did in this webcast. Now, another thing that Kevin and I would strongly suggest you do is to follow your favorite Schwab presenters on social media. You can find Kevin and me on X. You can find Kevin on X at Kevin Horner CS. You can find me here on X at Cameron May CS. I'm very active on X, and if you reply to one of my posts, I just try to reply right back to you. So it allows for interaction when the camera is not on. Now, another place you can now connect with me is on LinkedIn. Just go to linkedin.com/in/Cameron May CS, and that'll take you to my profile, and you can give me a follow here too. John, thank you. Yeah, I try to be thorough. I certainly do try to be thorough, and the trade-off there is there's always more that I wish that I could cover. So yeah, we get loose ends all the time. If I skimmed through everything, I could talk about every point I wanted to, like, oh, what about getting out of these vertical spreads? That's maybe a topic for more thorough discussion on another day. But Vic says LinkedIn seems too formal. It is more formal. I definitely agree with that, but not everybody has an X account. And so there are different ways to contact your, presenter. So I'd love to see you on either platform or both. But Kevin, thanks for helping out in chat. Everybody, thanks for all the thumbs up. Definitely appreciate it. 154 people watching, and it looks like 48 have already clicked the thumbs up. Thank you for that. That's like applause. It also gives me a boost in the YouTube algorithm, helps more people find my webcast. Guys, go have a great day. I will look for in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.